Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. When last we met, as they say, the market was in the middle of a little bit of a pullback. But then, by the end of last week, it shot up to fresh 2009 highs. So what's going on? Well, our panelists are here to tell you. Steve Reitmeister, our editor-at-large, our senior market analyst, Charles Rotblatt, and our top market technician, Kevin Matris. And so it goes, gentlemen, with what's going on here with the market. I'm getting like dizzy, seesaw, up, down, sideways. Kevin, there are some chartists out there, for example, who say the Dow's headed to 12,000. What's going on?
Well, before we hit 12, it's going to have to hit 10 and then 11. So we'll see if 12 comes. But last week it was interesting because the market seemed like it was teetering on the brink of rolling over. And I believe that the falling consumer sentiment numbers, the weaker retail numbers, since those had been some of the strongest reports that really got this market recovery going in the first place, when they started to weaken, I think a lot of people got spooked. Mm-hmm. But on the same token, you had stronger than expected industrial production, you had a lot of really good manufacturing data, and I think this helped blunt all of those negatives. Mm-hmm. And you can see this too, this whole stuff was underscored by the Fed and Ben Bernanke, because they had said that they believe the worst of the recession was behind us. They have seen or believe that we are seeing economic stabilization. And not only are you seeing this in the U.S., you're seeing this really around the globe. There are many other countries who are seeing growth rates a lot better than ours. I think when our Q2 came out, our Q2 was significantly better than Q1. I don't know what the rest of the year is going to look like, but all of that stuff does underscore the idea that we are seeing economic stabilization. The only thing that is perplexing the market has been high unemployment, but jobless claims numbers, in spite of last week, have been coming in a lot better than expected, and I believe this is really what is giving the market the fodder to continue its upward ascent. And
when we say last week, I'll just let everybody know that this is the 24th of August that we're taping this on, so they've got some kind of a time reference here. All right, but Mr. Rotblatt wrote in a blog that stabilization is not growth, okay? And he's going to probably stick by those words, right?
I am, and I do think well, first of all, the bulls are clearly in charge, and there's no argument about when you look at the market action about who's running the markets right now. It's clearly the bulls, and clearly the trend's actually pointing towards further gains, not a pullback. But I think you have to look, despite all these green shoots that are out there, we are seeing a lot of weeds, and it's very important to realize that when you're in a V-shaped type economy, or really a V-shaped type recovery, there's no way of telling that it's not actually a W.
So you're looking at the big picture.
I'm looking at the big picture, and I do think there's a giant sucking sound, to quote Ross Perot, coming out of 2010 into 2009.
You told me that last week too.
But I do think you're looking at, when you look at the cash for clunkers, that definitely took some cars away. I think when you're looking at home sales, we did have existing home sales rise for the 4th consecutive month, but foreclosures played a big role, either directly in terms of foreclosed houses being sold, or with foreclosed houses bringing down prices of other houses. And I think when you mix that in with a new the first-time home buyers credit, which will expire in November, that's giving people a lot of incentives to buy now, whereas maybe they would have bought in 2010 or bought in 2011, and they're accelerating those purchases. That program could end in November. And then now you're looking at the seniors, and we're hearing that they won't get an increase in their Social Security checks.
For 2 years.
For 2 years, and for some people that could impact their spending. So I do think...
So I won't be retiring.
So I do think we're looking at a period, though, of really slow growth, which is what I've been seeing. And when you're seeing the market rally, at a certain point you have to ask, okay, what happens when the stimulus ends? We're starting to see that fear kind of displayed out in China, where the markets wobbled a little bit there last week. And so I do think, perhaps the bulls are a little bit too giddy right now.
So I just want to be clear. Do you feel that this rally is based on economic stimulus?
Well, I think it's contributing to the sentiment, and I do think the reality is the economy is stabilizing, but I do think some people are a little bit too optimistic and not really thinking down the line what happens when the stimulus pulls back? What's the growth picture really going to look like?
One thing I have to say, though, just from my observation point, is that it seems to be, despite the choppiness in the market, a somewhat orderly rally.
Yeah, I think it is, because I'm going to quote Kevin Matris here. So we're going to talk about great investors or great people in history. So we're going to quote Kevin Matris here.
All right.
The trend is your friend until it's not. Okay, okay, that's another great Kevinism. So right, the trend is your friend until it clearly shows that that's not the case. And so there is some bullishness in the marketplace. When we talked last week, as you said, there was some fear that the consumer sentiment numbers were not very good, and the market started to pull back. It was I think about a 3% negative move in a couple days, and a lot of people were talking about there's probably another 5–10% in that. But when people were taking a look at the bigger picture of what is going on, and the industrial production was good, and then you get up till Thursday when you got the clear indication that jobs, yeah, a little higher, the job loss was a little higher than expected, but in the realm of acceptable, and then the broadest measure, one of the broadest measures, the leading economic indicators saying, guess what, folks, another month of improvement, okay? And the coincident indicators were better. So that was really like okay, you got to have all these bits and pieces, but something like the leading economic indicators is a very broad measure of what is going on out there that is clearly pointing to a recovery. So that is why the market continued its rally and then extended into higher territory, and that's where we are today.
All right, so Charles, given all of the choppiness and everything that we've talked about here, as far as investors are concerned, how would you advise them to try to set up an investment strategy for this kind of a choppy market?
Well, I don't think it's just this type of choppy market. I think you really need to look out over the next couple of years. And I think the key word is diversify. And that's nothing new. It's always been the case. But I think in this case, diversify, it's not only diversifying across industries, but really diversifying for either faster than expected growth or slower than expected growth. And I think that type of scenario, you got to look at things that could benefit if the recovery is actually better than people think, including myself. And I think in those terms, you might be looking at tech would do well. But I think you need to balance it with some stocks that are more conservative staples. A good example is J.M. Smucker. We hold the stock in the Zacks Elite Focus list. We're seeing earnings estimates going up there. Certainly in any type of economic environment, peanut butter and jelly is going to sell well. But I think you also got to look internationally, look at other countries that might be doing well. Conversely, I know a lot of Dow theorists are looking at the transports, and I think you got to take a look at what's going on in oil. It's right now in the mid-70s. Granted, that's 50% lower than what we saw at the peak of the bubble last year, but fuel prices are going up, and when you look at the transports, they've been rising up as well. So I think when people do look at the markets and are looking at all these stocks and all these charts that look really well, they need to have a little bit of a step back and ask themselves what could realistically do well given the current trends if we do end up in a slow growth environment, and even if growth tends to be a little bit better. And I think having a portfolio that's really diversified not only across industries, but has some growth along with some more stable companies could actually be the best strategy to use in the current environment.
All right, what do you think, Steve?
I'm not so much for the stable ones right now. What I'm saying, but I'm not necessarily that aggressive either. The stable stocks are in general being overlooked right now for the ones that will do better in terms of recovery. So there's nothing wrong with having one or two in the let's call it the boring camp because it's safer for your money. But I like the companies and some of the industries that have done surprisingly well in the worst of times, okay, and that with any uptick in economic activity will continue to outperform. A couple names that come to mind are like Newell Rubbermaid with the symbol of NWL. It's a little more in the consumer discretionary camp. They have done a great job of cutting costs, and they have greatly beaten their numbers, but the consumer's not there yet. So once there's any pickup in consumer activity, that stock's really going to take off. So they've done well when it was terrible, and will do better when it gets better. Target is a larger name that's in that same camp, that's in between consumer staples and consumer discretionary, that will do better as things improve. Rock 10, a paper packaging company. The better the economy is, the more things need to be packaged up and shipped or and sent. And so these are some of the names that stick out to me that have weathered the storm very well and any pickup in economic activity, they're just going to do better.
Kevin, what should investors do as far as investing in this environment?
You know, first off, I really do expect to see the market to continue to go higher. I think the big rush to the downside that we saw in March, I think it was completely overdone. And I believe it is conceivable that we could see the same kind of extreme to the upside, which is kind of what we are in the midst of right now. I believe the areas of focus, though, I believe that that industrial companies, manufacturing companies, and these types of plays, I think these are the places that are going to be assuming some good leadership roles. You know, this would include heavy construction companies, for example, not just the companies that are situated here in the U.S., but companies that have business exposure internationally as well. Perfect example would be a company called CBI, which is Chicago Bridge and Iron. Yeah. Interestingly enough, they're not based in Chicago, nor do they build bridges, but, but they build a lot of energy infrastructure. This includes natural gas, this includes oil, this includes nuclear, and they do this all around the globe. I think other interesting plays will be basic materials. I think with inventory so low, I think the basic material producers, these are the ones who are going to really shine as people have to start building their inventories back up. Mm-hmm. And then you have transportation. Yeah, transportation usually is one of the first leading groups when you're truly entering into an economic recovery phase. I think this fits very well with the whole industrial basic material idea, and I think it's difficult to really place a bet on what part of the transportation industry is going to be the best, so I think an ETF like IYT is a good way to play it. I'm also still interested in tech, of course. That has been a leader. I think it will continue to be a leader. But I'm also getting interested in telecoms as well. But I think there are a tremendous amount of opportunity, and I really do believe that the market is going to continue to go higher because it seems as if that everybody who's wanting to see a pullback or waiting to see a pullback is waiting because they can't wait to get in, which means I think the market's going to keep on going higher.
Unless, of course, it doesn't. That's the latest from here. These folks are going to keep their eye on what's going on. You keep your eye on Zacks.com for updated commentary in a variety of areas. With everyone here, I'm Terry Ruffalo.